I think in the first instance, the lag in the gold markets is easy to explain. Gold has gone up because central banks have bought gold and they don't buy mining shares. I mean, this one's really simple. They're related markets, but the buying class has been different. If you look at the flow of funds in retail ETFs, gold ETFs, for 48 months, there's been only 7 or 8 months that had positive retail flows. The buyers of gold have been foreign central banks, and they don't buy gold. There's a different problem, of course, and that has been the corporate performance of gold companies, particularly in the period 2000 to 2010, where the gold price went up 7-fold and the free cash flow per shares fell. It took real skill to screw up an environment where the selling price of your product went up 7-fold. And so there's an expectation of failure around generalist investors. I think that the remaining institutional investors in particular are holding the gold company managements to much higher standards. It has been less evident because at the same time that the gold price went up, the cost of some inputs around gold mining has increased. And so you haven't seen the margin expansion that you would have hoped until the last 6 months. But now you are seeing some of the more efficient producers, in particular the producers that have maintained their sustaining capital costs, Lundin Gold, Agnico Eagle, Alamos, as an example. You've seen in the last 2 quarters some gold mining companies that haven't merely beat expectations, they've obliterated them. And I think that continues. You're seeing actually very good free cash flow generation in the gold mining industry. And if this performance keeps up, and if the gold price keeps going up, I'm constructive with regards to both. My suspicion is that you're going to see some of the delta, the historic delta, between the gold price and the prices of gold equities. I also believe that because of U.S. debt and deficits and the necessity, from my view, of inflating away the net present value of those obligations, that the gold price, although it's performed very well for the last 25 years, will perform better. I drew your listeners' attention to the decade of the 70s, when the U.S. dollar purchasing power declined in excess of 75%. It's worthy to note that the gold price went up 30-fold. I'm not suggesting that we're going to have a 30-fold escalation in the gold price, but I am suggesting that the pace of increase that we've seen in the gold price will accelerate as the pace of purchasing power deterioration of the U.S. dollar accelerates. And I think that will draw attention to gold. One more little piece of arithmetic, if I might. I realize arithmetic makes a boring show.
No.
It's useful for your listeners. Gold is way, way, way under-owned, Peter, historically. J.P. Morgan Chase tells us that the market share of precious metals and precious metals securities in the U.S. market is less than 0.5%, which is to say less than 0.5% of total U.S. savings and investment assets are comprised of precious metals and precious metals-related securities. Although J.P. Morgan doesn't have data going back 40 years, they estimate that the mean market share of precious metals and precious metals-related equities is 2%. So if interest in the stuff merely reverted to mean, demand increases 4-fold. I'm not smart enough to tell you what that would do to price. I have no earthly idea. But one would suggest that a 4-fold increase in demand, at least on the precious metal side, if not the precious metals equity side, where supply growth is fairly constrained, would have a very outsized impact on price. I think their relationship to the metal was partly defensive and partly arithmetic. The attempt by the U.S. government to weaponize the SWIFT banking system, which wasn't our property, it was global property, and to use it to impose extraterritorially U.S. policy preferences on other countries, didn't go unnoticed by other countries. But I think the straw that broke the camel's back was when the US government stole $300 billion in Russian assets. I'm not suggesting, by the way, that I support Russia's actions in the Ukraine. What I'm trying to say is that the Russians bought $300 billion worth of US treasuries, a friendly act, perhaps in their interest, not in ours, and then we stole the assets. Now, if you were a country who thought that some of your policies might become anathematic to Americans, let's say you were Chinese or Iranian or Saudi or South African, there were two very good lessons there. Having control of the world's reserve currency and then weaponizing it for the extraterritorial imposition of your political will is not a way to build your franchise. And I have been told, and I won't tell you by who, but I used to sell, as you may know, to sovereign wealth funds earlier in my career. I have been told when I asked this one person whether they trusted us, he said, "Oh no, but we trust you more than we trust each other," which is to say, the US dollar is the worst currency in the world with the sole exception of every other currency on the planet. The Russians don't like us, but they actually like us better than the Chinese. And the Chinese don't like us, but they actually like us better than the Russians. And the Iranians don't like either of us. Either of them. You follow what I'm saying? So the US dollar maintains itself as the medium of exchange among fiat currencies because they don't want each other's currencies. There isn't enough liquidity and there isn't enough underpinning. And now they can't use the US dollar as a settlement mechanism for everything because they're afraid the US government will steal their assets. A second problem is that the governments, I think, see the deteriorating purchasing power that they would enjoy in US dollars. If you believe federal government statistics, that they would measure the deterioration of the purchasing power of the US dollar by the CPI. And that number, I think, is 2.6%. If that number were real, it wouldn't be so problematic. But I would ask your listeners who are American to look at the period 2020 to 2025 and think about the price of the basket of goods and services that they consume. The price of gasoline, the price of groceries, the price of rent, the price of mortgages, the price of healthcare, the price of the price of health insurance. John Williams, who publishes Shadow Stats, says if you measured U.S. inflation using the metrics that the government itself used in the decade of the 1970s, the price inflation in the United States would be at 12%. The number I use, informally looking at my own, basket of goods and services, is the deterioration of the purchasing power of my currency is at about 7.5%. So if you're a foreign holder of U.S. treasuries, then the arithmetic becomes I'm getting paid 4.5% a year in a currency where the purchasing power is declining by 7.5% per year. In other words, I'm losing 3% a year in purchasing power. If I give the U.S. government $1 billion for 10 years, 35% on a compound basis of my purchasing power is gone at the end of 10 years. And they probably use the principle to subjugate me. Not a particularly good trade. And let's talk about that. First of all, the last 2 years have been pretty good to me in that space. It's been a stock picker's market. If you look at the performance of the overall market, it's been dismal, and it should have been. I think if you merged every public junior in the world, there's maybe, 3,000 of them, 2,500, 3,000? So let's say you merge the Australian ones and the AIM ones and the Canadian ones and the American ones, and you have one great big company now called Junior Explorer Co. That company in a good year would lose $2 billion. In a bad year, to lose $5 billion. So what would the market pay for this? Would you pay 8 times losses? No, what's the price-loss ratio? That obscures the fact that in a universe of 2,500 of the lame, the halt, and the blind, that maybe 10% of the issuers generate so much utility that they add legitimacy and sometimes even luster to a sector that loses between $2 and $5 billion a year. You have to separate the wheat from the chaff. And there is actually an increasingly large number of good people in the sector. And while the performance of the sector is dismal, the performance of names like, G Mining, Snowline, I could name 50 of them that have done superbly well. I had the good fortune of taking a very, very, very large cut at the Lundin companies, which I've been doing for 40 years. So Philo, NGEX, those were my leading performers. And mercifully, they were also large components of the account. But the recoveries in names like Altius, certainly Snowfield, certainly G Mining, where I took a very, very large cut. There have been a lot of names that worked. There are also some names that haven't worked, but they've added an awful lot of value, if not price. I'm thinking about names like Sovereign, Meteoric, Centaurus, companies that have made what appear to be tier one discoveries in out-of-favor commodities and out-of-favor places. This sector, unknown or unliked tier one deposits, has been the most prolific sector for me for 40 years. Buying what you think, and there's a lot of problem defining tier one deposits. I would define it as a deposit with well over 10 billion US dollars at current prices in situ recoverable reserves and resources, where the deposit would be in the best cost quartile worldwide in its commodity category, while simultaneously being in the best return on capital employed quartile worldwide, but at least a 25% return on capital employed.